Hey everyone, so today we're going to give a in-depth market report, what's going on right now in the market. We're also going to talk about rates, interest rates, Fed funds rate, how that affects you as a buyer or a seller. We're also going to talk about inflation, what's going on with that. Your interest rates, your inflation, how that affects you as a buyer and a seller. Also, I've been hearing people come to and talk to me about the differences between 2008 and now with regards to the pullback in the market. We're going to talk about that because I was actually involved in 2008 in the secondary market in the mortgage field. So I was in the depths of that when all of that stuff happened. And we'll also talk about, the calamity that it was at the time and the differences between 2008, 2023, and why those two scenarios are not the same. So let's get into it. Let's get right into it. What do you think, Nicole? Get right into it? All right, that's what I'm talking about. Thumbs up. So first thing we're going to talk about today is the market report as far as existing home sales. This is an important metric to look at when looking at your housing market. So an existing home sales is not new construction. It is homes that are already existing. They're on the market, or I shouldn't say they're on the market. They're built and they're trading, whether they're being bought or sold. So, and those are obviously the same thing. So, existing home sales, and this is going to measure the sales and prices of existing single-family homes. So, we're not going to really get into condominiums. I can do that in another episode. The data is a little different. I figured for the general public, single-family homes would be the best thing to talk about. And this is in the nation. So it right now is down across the nation about 1.5%, almost 2% for December. And the important metric to look at here is that's the 11th consecutive month that report has been down. So obviously we know that the market has retracted. It's pulling back. Much to do because of the interest rate market. So and inflation and some other factors, but the things that are weighing on it the heaviest that we, in the industry we're looking at are inflation and your interest rate market. So some median home prices. What I'm going to do is give you some median home prices year over year. So this is going to give you an idea of where we were in 2021 versus where we are in 2022. And so this is going to be this is important. It's good data, so you can compare it. So, and this is not seasonally adjusted for different seasons, school, things of that nature. This is just your basic raw data. So, in the United States, from 2021 to 2022, you're looking at a 35% dip from existing home sales from 2021 to 2022. It's almost 36%. You are down. In the Northeast, which is where I am, you're at about a 34%, 33.9. So at a 34% drop from last year to this year, existing home sales, the number. Okay. In the Midwest, you're at about 32.5% down from 2021 to 2022. In the South, you're at a 34% drop, 2021 to 2022. And in the West, that's your biggest pullback. Probably the California markets and the Arizona markets and the Las Vegas markets, I'd imagine, are your three biggest there. 44.5% was your pullback year over year. From 2021 to 2022, you were down almost, that's almost 50%. It's almost half of the sales you had in 2021 to 2022. That is a huge number. Huge. So, yeah, that's again, and this is from the National Association of Realtors. So they have pulled data from, existing home sales, and that's where you're at. So those are some really, really telling numbers. Let's get into, so there was 79 pages of counties in the United States, every county. And what I did was just pull the top 7 as far as your highest average median home price county to the lowest. Your highest median home price county, quarter 3 of 2022, was San Mateo County in California. Their median home price Q3 was about $1,575,000. That was your median home price. California are your top 4 counties. Then there's one in Nantucket, Massachusetts, and Dukes County, Massachusetts. I don't know if a lot of you know, there's a county in Wyoming called Teton County. That's 7th on this list, with an average sale price of $1 million. Your median home price of $1,102,000. So now what I'm going to do, I want to give you your monthly payments from 2021, where your interest rates were, and now your monthly payment in Q3 of 2022. So the difference between your Q3 monthly payment, your mortgage payment, 2021 versus 2022 in Q3. Okay. So let's just go. I'll pick a random county. I'm close to New York, so let's do Kings County, New York. Okay, your median home price in 2022 Q3 was $878,630. Okay, so your median home price is about $878,000. In 2021, your monthly payment on that would have been about $2,960. In 2022, with your interest rate increase, rate changes, your payment on that is $4,550. That's like $1,500 a month more. It's like a 50% payment. If you know what payment shock is, the increase in what you were paying to what you are paying. If it increases a certain number, a certain percentage, they call it payment shock because it's such a high number, a high increase. And in the lending industry, it used to be this way 20 years ago. If you had payment shock, they would force you to have an excess of assets to cover that payment shock to make sure that you have the money to pay that. So I don't know if that still applies now, but they did back then. Los Angeles County, California. Everybody knows Los Angeles County. Your average sale price in Q3 2022 was $827,760. In 2021 Q3, your mortgage payment on that was $2,690. In 2022, $4,290. So that is a 13. That's $1,300 more from one year to the next. This is a huge reason why you're seeing the pullback in buyers purchasing property, because of the difference in payments over one calendar year. We went over this in previous episodes. The Fed raising the overnight lending rate, which it's not directly affected to the mortgage rate, but it affects, and we'll get into that a little bit too, it affects the 10-year Treasury yield. And the 10-year Treasury yield's like 80%, 85% of the 30-year fixed mortgage is based on that index. So the overnight lending rate being heavily influenced by that has a lot to do with your rates. So that's why you're seeing a big reason why you're seeing, it's not the whole reason, but it's a big reason why you're seeing this big pullback. Let's go over a couple more counties. Maybe we'll grab one near you and the difference in payments. I mean, it's just huge. Let me grab one in New Jersey. We're not on to, I think, page 3. Yeah. All right. So Monmouth County, New Jersey's average sale price, Q3, median home price, I should say, $559,870. It's almost $560,000. In Q3 of 2021, your mortgage payment on a $560,000 mortgage or $560,000 home, your purchase price, your mortgage payment's $1,890. It's less than $2,000 a month. That's insane. That's how low your rates were, artificially deflated, just to keep that in mind. 2022, $2,900, so almost $3,000. So it's like $1,100 difference, almost $1,200 difference. Morris County, New Jersey, same thing, $558,000. Your 2021 mortgage payment, $1,880. 2022 payment, $2,890. So about $1,000, a little over $1,000. But this is the difference you're seeing. It's like double. It's like 50% more. So it's a lot. It's you're talking about a $1,000 difference. It's like, yeah, you're talking high numbers here. So that's the difference. Hudson County, New Jersey, where I'm sitting right now. Your average median price was $518,000 for a single fam. Mortgage payment $1,750 in 2021, 2022 $2,680. So a little under $1,000. Big difference. It's a big difference. So I just want to give you an idea of interest rate, like your existing home sales, and then your median prices with those. Okay. So you're seeing these National Association of Realtors existing home sale numbers. You're seeing these dips 35% on the number of sales year over year, down 35% in the U.S., down 34% in the Northeast, down 33% in the Midwest, down 34% in the South, down almost 45% in the West. It's a huge number. That's almost 50%. It's almost 5 out of 10. Like, that's a huge number. So seeing this huge pullback, it just goes to show a big reason why, again, you're seeing these mortgage payments almost double. Some of them are $1,300, $1,400 more in one calendar year. Yeah, it's going to have an effect on someone. This episode is brought to you by The Elite Builders. It's brokered by eXp Realty. I've spoken a lot about Elite Builders and the value stack that you get just by partnering with us. There's tons and tons of value here. But again, aside from the financial value, which we'll get into in a minute, becoming an Elite Builder, really, you're going to basically change your life in every facet: physically, emotionally, mentally, spiritually, and financially. What do I mean by that? You're going to be in proximity to people that operate on a high level, high character, high integrity. We're creators. And what do we want to create? We really want to create leaders and inspire you and others to be the best versions of yourself, highest version of yourself that you can be. And when you do that, you're now operating at a high level, and you're going to then inspire others to do their best. And then when you want to talk about it from a financial perspective, as far as if you're an agent or a broker, the value stack that you get free group coaching. All right, so let's go through them. Group coaching, it's a $3,000 value. You have role play groups that I run 2 of them, 7:30 and 11:30, where you learn scripts on what to say, how to say it, and how to say it with confidence so you can help serve your clients to the absolute highest level. That's a $1,000 value. There's an exclusive ladies mastermind group. Okay, that's a $3,000 value. Very, very high these women are operating at such a high level. They have their own exclusive mastermind. Awesome women in there. That's a $3,000 value. The scripts and the courses themselves that you get, expired, for sell by own, or just listed, just sold, pre-qualification, listing presentation, objections, all of it. You get that and the courses that are online in like 40 different languages. That's a $1,000 value. The systems training, the CRM training that you get, the systems training itself is a $2,000 value. So we train you on how to put systems in place so you're operating your business at the highest level possible. So we have that. The CRM training, which is basically your database, we teach you how to put all of your clients into a database, and then it serves you and feeds you as far as contacting them, how often, and how to serve them. It's so it's basically where you're housing your whole business. That's a $1,000 value. And then the events and the webinars that we have, another $1,000 value. Like, you're looking at over $10,000 in value that other agents that aren't partnered with eXp pay. And when you do partner with us, these are all free. They're literally all free. So if this is of interest to you, just reach out to me. Again, you can subscribe to the channel, Dan the Man Talks Real Estate. I'll send you more information about it, or you can reach out to me on the other platforms, TikTok, Instagram, Facebook at Daniel Masrobian, and we'll send you all the information you need to get you started on, again, just building your life and partnering with us to be literally the best version of yourself that you can be. So Now, having said that, let's talk about rates right now, okay, and your present time. So in January, I think it was January 31, February 1, the Fed met, your central bank, Fed, central bank, one and the same. They increased the overnight lending rate 0.25%, so 0.25 BPS, basis points. Okay. Now, in the aggressive increases in 2022, they were doing it 0.75%. I think they even did it a full percent once or twice. So they've now tapered that down to 0.25%. So they're still increasing it, just not as aggressively. So not like we've seen in the past in 2022. So right now, the Fed funds rate, it sits at between 4.75%. For reference, that's 8 straight times the Fed has raised the rate to reduce, liquidity and, to the markets. And what they're trying to do is drive down inflation. They want to get that inflation number down. So, and 4 times in 2022, 4 times, they raised it 0.75%. So it's a big number. And again, why in one calendar year you started at some lenders were given 3, you might have been able to find 2 7/8 in the beginning, like January of 2022. And then by the end of 2022, you were at 7%, some of them over 7%. So that's more than that's more than double an increase in rate in one calendar year. That's never happened in the history of the United States real estate. It's never happened. It's insane. So that's why you're seeing this aggressive pullback of, 40% in certain areas, 45% in the West. You're seeing these existing home sale numbers, dipping 45%, 35%. That's why a third, they're at least a third in almost every market. So some of them more, some of them almost 50. So that's why you're seeing that. So that's where we're at right now. Now, keep in mind, and I want to share this with you. The central bank, like the Fed, when they raise the overnight lending rate or the Fed funds rate, which is the rate that banks lend each other, when they raise that, that's not directly tied to the fixed mortgage rates. It's not. They, usually what happens with one is what happens with the other, but they're not directly tied to each other. That's what I was mentioning before. But the Fed does have influence over that 10-year Treasury yield. And that's I think it's 80% or 85% of the 30-year fixed rate is based on that index, that 10-year Treasury yield. So it's heavily tied to that. So when the Fed raises that overnight lending rate, that Fed funds rate, that's heavily tied to that 10-year Treasury yield. The 30-year fixed rate is heavily tied to that 10-year Treasury yield. So when you see that 10-year Treasury yield dipping, mortgage rates are going to follow. You see that 10-year Treasury yield starting to rise and creep up, 30-year fixed rate will do the same. So keep those in mind, okay? So that's where we are right now from an interest rate perspective. I'm going to talk in a little bit about why I think it's a good time to buy. And I know that I'm in the minority here, but shrewd buyers that make money in real estate, they don't do what everybody else is doing. Now, I know I'm in the minority here, but again, I just feel like, and this is like Warren Buffett, man, whatever everybody's doing, he does the opposite. So when everybody else is selling, he buys. When everybody else is buying, he sells. And I feel like all the buyers are pulling back because they feel like rates are too high. And they're not. They're actually average. If you look at the interest rate market over the last 40, 50 years, this is average. We've just been conditioned to think that 2 and 3% is really is what your average is. It's not. It was ridiculously low and artificially kept low because the Fed was they wanted to keep the train going because they were really worried about COVID and the results of that. So that's why they kept it down. That's not normal. Your average rates are 5-6%. What are they right now? They're 5.9, 6.1, 6.2%. That's your average 30-year fixed. I think it's 6.4 right now. 30-year fixed, 20% down. Your good FICO, top tier FICO with good assets. You're getting 6.25, 6 3/8. That's an average rate. But we've been conditioned to think that 2.5%, 3%, that's what your rate should be. It's not. So will rates come back down at some point? Of course they will. They have with 100% certainty every time rates have risen. So we know that. It's like seasons. What comes after winter for eternity? Spring. What comes after spring for eternity? Summer. Like these things just happen with certainty. So we know that rates are going to come down. All right, let's get into this now. So think about this. What was the biggest complaint with every buyer that I talked to in 2020 and 2021? Biggest complaint. Dan, there's 15 offers on this house. I can't get it. I keep getting outbid. Why is that? Because rates were so low, most everybody could get into a home that normally on an average rate might have stretched them thin. So now it brought a whole new niche of buyers into the market. So that was everybody's biggest complaint. Now rates have stabilized and gotten to, they're not at 8%, 7-8% where they were. They're at like 5 and 6. That's too high. So we're gonna wait till rates go low. Okay, so now we're gonna have the scenario we just had in 2020 and 2021 again, and that's when you're gonna jump back into the market. It doesn't make any sense. If you can afford the property now, that's the key phrase. If you can comfortably afford the property now, with 20% down or whatever much you want to put down, I'd almost tell you to put less down. It doesn't matter. Keep the cash liquid. Keep the cash as liquid, and but you're getting equity. You're buying because prices. You see the data is telling you prices are coming down, so you're buying the property now at a discount. So what? So the freak what? If you're paying a little bit more for it for the first few years, who cares? You're buying equity. Rates are going to come down. What are you going to do? You have the equity to refinance it, so just do a rate term refinance. Get the payment down. Maybe you'll save $600-700 a month. Now you have a property that's a low rate, and you have equity in it. Oh my God! Then what you can do? You can put a HELOC behind the first. It's like a checkbook, and then if you see another property you like and it's at a discount, you can buy that one too. Now you have two properties with the first one you bought. This is how people accumulate a real estate portfolio. But you're conditioned to think that rates are high now, and they're not. So I'm just going to present to you this thought of maybe they're not. You just think that you're used to 2.5%, 3%. That's what my rate should be. No, that's not an average interest rate. It's not. You just were in a slice of time where it was very, very low. Now, again, if you got a property at that point and you were able to win it and buy it, congrats. Keep it, and I would highly advise you to just, again, keep it unless you're getting relocated and you got to sell. No problem. I can help you out with that. But moving forward, if you're looking to increase your real estate portfolio, this is a good time to buy, especially this season. It's February. Okay, most buyers are sitting on the sidelines and waiting till all the inventory comes out. Why don't you be a shrewd buyer and see what's on the market now? Because I'm always advising sellers when you're going to look to list your property, don't list it in the spring when everybody else does. It's silly. You're going to be a small fish in a big pond. Everybody's going to now be listing when you are. What if you listed it a month early and now you're one of the only ones on the market? You're going to have everybody's eyeballs looking at you. This is like, again, it's what makes your average person acquire real estate in their portfolio with regularity, and then it turns them into a millionaire because you continue to buy at the right time. You're buying at the right time when the market is down. Don't look at the interest rate. I mean, I can't say this strongly enough. If you can afford it, don't look at the interest rate. Just look at the property, what it was a year or 2 years ago, the value of it, and now what the value is now. I can almost guarantee you in most markets that I practice real estate in, it's down. So you're getting a discount. It's like I've never. You wait for items in the grocery store to go on sale, and then you go buy them. Like, why is it a problem when you're going to go buy a house and the house is on sale? It doesn't make any sense. You wait for a car to come on sale. You wait for everything else to come on sale. But when real estate comes on sale, you're like, no, I'm just going to wait. It costs too much. It's like the train of thought doesn't make sense to me as an investor. But again, I'll never force somebody to do something that they don't want to do. So just keep that in mind for your average person who's looking to increase your portfolio. And I will leave it at that. October 7.7, November 7.1, December 6.4. So you see it go like this. Well, inflation's going like this. Why? Because your interest rates are going like this. So exactly what the Fed wanted to do is what happened. They're aggressively raising those rates 0.75% 4 times in 2022, and then you saw the inflation come down. It was a direct tie. 9% in June, 9. So from 9% in June to December 6.4. It's almost a 3% drop because they aggressively raised that rate. So that was a total of 8. The average was 8% in 2022. Okay, so that's your inflation. Again, you saw that. I mean, tell me anybody who didn't feel that going to the gas pump or going to the store and you're buying groceries. Was your bills a lot higher? Did you get your grocery bill and you're like, oh my God, like what's going on here? Who broke a window? Yeah, that's inflation. So now what I also have is a chart for different inflation related items. So let's go over those. And this is January 2023 or December 2022. I will correlate between the two. It's only a month difference. So your inflation rate in January 2023 is 6.4%. Okay. Now that's a percentage, and that is in January of 2023. Your CPI, your Consumer Price Index, goes on points. The last one in January of 2023 is 299.1. Okay. Now your export prices go in points as well. Your import prices go in points, 151 and 142. I know many of you don't really know what that is, so we won't get into that. But food inflation, this is important. This is what it directly affects us. Everybody has to eat 3 times a day at least, some more, some less. Food inflation, 10.1%. That was your food inflation in January of 2023. So your food that you bought is 10% more in January of 2023 year over year. 10%. It's a lot. It's a very high number. Your energy inflation, 8.7%, January of 2023. So just what energy, what it costs to heat your home, cool your home, things like that. Buildings, office buildings, where I'm sitting right now, 8.7, almost 9% more. So these things all have an effect on people. Your rent inflation, this is a big deal here. Rent, 7.8%, so almost an 8% rent increase from January of 2023. So these are direct costs to us. We want to look at it as a cost to us, what it costs from one year to the next. 8%, 10%, food, energy. These are things that directly affect your wallet. So when we know that our wallet is being directly affected and it's in a negative manner, it's costing us more, and we see interest rates rising, and we see inflation at a 6.5%, 7%. It was at 9%, 10%. I still think it's higher, but I'll go with their data now. Like we know that our elected officials love to play with data. So do I think it's higher? Yes, 100%. So knowing all of that, does that cause a consumer to go like this with their wallet? I would probably say yes. Grabbing their purse, putting their wallet away, it doesn't incite spending and, confidence. So that's why, again, it's another reason why you see the inflation rate. You see people pulling back and waiting. That's understandable. But if you have, I'll say it again, if you have the capital to purchase a property and you want to purchase, that's in your goal, or it's just something that you need to do because of life events, upsizing your family, downsizing your family, maybe a death in the family, a job relocation, anything like that, and a purchase is needed. If you have the money and the wherewithal to handle that payment that's a little bit higher now than it was, do it. So that's inflation. Okay. Now, one of the other things that I've been getting a good bit of lately is because I was involved in that 2008 market meltdown. I was working for a lender on the secondary market, buying those assets that were toxic pools, that they called them, quote unquote toxic pools. They weren't really toxic. We'll get into the Big Short in a minute, but I love how the Fed and all these elected officials use the word toxic. It's ridiculous. It's toxic because of what they paid for it. So keep that in mind. They paid a bad number for it. So then what did they do but label it a toxic asset? No, you just didn't do your due diligence when you bought that pool of mortgages. If you dove in and looked at every single one of them and noticed that they were a stated income loan, a no income, no asset loan with no verification whatsoever on a secondary or an investment property in Vegas or Arizona, you might not have rated that in a paper and then bought it at the price you bought it at. It's only toxic because you paid a high price for it because you didn't do your due diligence. So we can get into like the whole how this all happened, but there's a lot of the monstrous amounts of the culpability lays with the people who actually purchased these assets, these credit default swaps. It's crazy. So anyway, I digress. We're going to get into 2008. Nicole's looking at me laughing like, what are you even talking about here? I see you over there. We'll get into that in a minute. Don't worry, Nicole. This is a great book, man, The Big Short. We'll talk about this in a minute. The movie's great for, someone who's not in the industry, who doesn't understand terms like credit default swaps, collateralized debt obligations, and things like that. They don't know. So, and it's okay. Like if I wasn't in the industry either, I wouldn't know. So we'll get into that, but I'm reading it again because it's such a good book. The movie's great. It lays it out for you line by line what happened, but if you really want to get a good glimpse of it, Michael Lewis is a phenomenal writer. He wrote Moneyball. I'm sure if any sports fans out there, Moneyball was one of my favorite movies of all time. And he also wrote Flash Boys, which is about the high-speed trading, and The Big Short. So to get into 2008, Dan, is 2008 the same? Is this the same as 2008? That's what I'm getting asked. Is this pullback the same? And the answer is no. And I'm going to tell you why the answer is no. So I broke it down to like 4 reasons. Okay, 4 things. Yeah, 4 reasons. 4 reasons why. The number one reason, in 2008, we had a very high supply. So from when you remember the 2001 attacks on the Trade Center, I'm sure everybody remembers those. Right after that, our elected officials were very, very scared that humans in this country were going to pull back like they are now and not do anything as far as buying, selling, purchasing, even consumer goods. They're very worried about that. They're worried about markets, stock markets, and all those other commodities markets. They're worried about everything, just doing a huge pullback. So what did they do? Many of those commercials that you saw from like late 01 on, where it is your right as a consumer and a home person to buy a home. You should be a homeowner. It's your right as an American. And they pushed home ownership. So that's 02, 03 is really when it started to like skyrocket and go like this. If you look at the history of the United States real estate market, the only time it ever literally the line went like this with values and properties was from 01, 02 to like 07. Like it never did that before. And what happened was you saw a lot of builders building these huge developments, like plots of land they're buying out in Arizona and Vegas and Florida, and they're building these huge developments thinking that this was just going to keep going. This machine was going to keep churning. People were going to keep buying. So they were banking on that. There was a very high supply of inventory in 2008, very high. So when the markets came down, when 08 happened, 07, 08 happened, and everything kind of started to crash, these developments, 100, 200, 300, unit developments, more than that, some of them, they're all sat vacant. So now you had vacant homes just sitting there. So you had a very high supply. So when everything crashed, you had everything sitting vacant. 2022, 2023, inventory is still very low. So you don't have that problem now. So, fewer vacancies, lower inventory. The properties that are out there, the qualified buyers that are here, they can still purchase. So you're not having that huge amount of, foreclosure vacancy rate. You're not seeing that now. So that's reason number one, is the supply. Reason number two, lending. This probably should have been reason number one, but I didn't go in any specific order. Reason number two, lending. All right. Lending in 2008, well, I should say 0102 to 08 was, I'd say the market was artificially lifted, kept up by mortgages people really couldn't afford. The stated income, stated asset loans, no income, no asset loans. On loans that you were stated income loans on a third investment property that the person was never even going to live in. So it wasn't even like an owner occupier where they were gonna move in and live there. It was like an investment property. So the market was artificially kept up by these mortgages in 2008. And when all those mortgage pools started to default, when rates went up and the economy turned, they all defaulted, like literally all of them. And the problem was, we can get into this, goes back into The Big Short. Like one mortgage pool, let's say Wall Street's going to, Bear Stearns was going to buy, and I'll use Bear Stearns specifically as an example because they're not here anymore. It's a 100-year-old company, and they're not here. Let's say Bear Stearns was going to buy that pool of loans that S&P's or Moody's put an A+ rating on. So they're saying that this, 5,000 mortgage pool, this pool of mortgages, and this one pool is getting an A rating. Moody's and S&P did not look at every one of those 5,000 loans. They didn't, because if they did, that wouldn't be A paper. It would have been like B, C, D paper. Okay? So, and again, the reason is because the income's not verified, and they only went off of a credit report. Nothing was verified other than credit. And a lot of times those were straw buyers. They weren't even the actual buyer. So they had that. So when that one, and what they did on that one pool, let's say that one pool of 5,000 loans, which they didn't underwrite each loan to see what the rating would be on that whole pool. They didn't do that. They rated it as A, and that whole pool is worth $10,000. Let's say we'll throw out let's use a round number, 100,000. Okay, so that whole pool is worth $100,000. They didn't just leave that pool at 100,000. They then leaned and borrowed against that pool 30 times over. So 30 times. So now that pool isn't worth, like if it defaults, it's not a $100,000 default. It's a $300,000 default because they borrowed against that like 30 times. So that was the problem. It was this monumental collapse, not of just one pool. It's 30, because it's like 30 times is you borrowed against that 30 times. So if that thing defaults, like the whole system comes crashing down. Well, now imagine that times like 100,000. Like, how many of those pools did they do that to? Hundreds of them. And all these companies did it. And AIG was one of the companies that insured these mortgage pools. They insured them that they weren't going to default. Like, yeah, they're A paper. We're gonna insure it that it isn't going to default. And then when they did default, these companies that bought against it and said, well, they're just going to default, they're like, where's our money, AIG? Like, we want our money. And that's when the government had to go in and bail them out, because all AIG was giving insurance on all of these. So this is just a little bit of a background on it. So, and look, Bear Stearns did it, Lehman Brothers did it, Merrill Lynch did it, other companies did it too. So did Goldman Sachs. But I believe in 08, 09, Paulson, was our, I want to say, Treasury Secretary, and he worked at Goldman Sachs. So it's kind of like who you know. It's a reason why Goldman Sachs is still here and those other companies aren't. That's just my 2 cents. Maybe I'm wrong, but I don't think I am. So that's just a little bit about, so lending. So this goes back to lending. So in '08, people couldn't, like the loans that were being given out, people couldn't afford. So you had this monumental collapse when the economy turned. 2022, 2023, the lenders are giving mortgages now to people that actually can afford them. They're getting all their income verified. They're not straw buyers. These are qualified borrowers that know they can afford this product, and the lender is giving them a loan based on their ability to repay. That's what a mortgage should be. Now, there is a market for there is a subprime market, subprime, quote unquote, because there's people that don't get paid a regular W-2 and a pay stub. I'm one of them as a realtor. Like, I don't get a pay stub and a W-2. I'm paid as an independent contractor, so I get a 1099. Any realtor does. So traditional lending sometimes can be challenging for us. Well, subprime markets were for that. Bartenders, waitresses, self-employed borrowers, people that aren't just a pay stub W-2. The problem was humans tend to, what is our nature? If there's a way to circumvent something to get something, we're going to do it. So then what they did was they used the subprime market for pay stub W-2 borrowers. So if a pay stub W-2 borrower didn't qualify for a mortgage, they'd just throw it on they just go subprime and then say, well, just do a stated income, stated asset. Now, there's no reason whatsoever for anybody who gets paid a pay stub and a W-2 to go stated income, stated asset. There's no reason. Everything is verified. But because they didn't qualify, well, we can go a different route, and I'll get you the loan this way, even though they couldn't afford it. That's part of what happened. I know what happened because I saw it happen. So, yeah, that's basically part of what happened. But again, getting back to subprime, there's a market for that, and unfortunately, because of what happened, it's a very limited there's not a lot of options in that market, and I think if there's a subprime lender out there, I don't know of any yet, but if there's one out there that is legitimate and does it the right way and verifies you're going to pay a little bit more on a rate as a subprime, as a non-traditional borrower, you're just going to pay a little more. I mean, it's just what it is. But at least you can get the loan. That's the difference between that. So that's the difference between then and now. Lenders are lending to borrowers with stricter guidelines, and people can afford the loans that they're being given. Back in '08 and '07 and before that, they couldn't. So that's a huge difference. Huge difference. So we're not seeing that mass calamity of foreclosures. Which brings us to number 3. The third reason I think that I know that they're very different is equity. So in 2022, like right now, as far as distressed property goes, I think the number right now is like 91% of distressed property has positive equity in it. That was not the case back in 2008, 2009. It was not. So there's a softer landing that's possible for someone who's going through a tough time and, with their home and the property's distressed. So there's other options for them. Back in '07, '08, there were no options. It was like, you got to I'm just going to walk away from it, which is what people did because they were underwater, and with the mortgage adjusting and getting massive payment shock, $1,000 a month payment turns into $19,000, $2,000, sometimes more. They couldn't afford it, so they just walked away. You don't need to do that now because a lot of these homes, not over 9 out of 10 of them, have positive equity. So that's the third reason. Let me take a break. How are we doing on time? All right, now that'll bring us to the fourth reason. 4, unemployment. All right, so this is a huge, huge difference between 08 and 09 and 2022, 2023. 08, 09, it was like mass hysteria. I remember it like it was yesterday. I literally was working right across from Goldman Sachs, my building. I was in 101 Hudson, downtown Jersey City, working. Same, AIG was in our building. We were on the 25th floor, I believe. I think AIG was on the 33rd floor. I'm not mistaken, but actually I am mistaken. AIG was below us, but Z100 was in that studio, was in that building too. So we'd always see, like, it was a recording studio. So sometimes we'd see celebrities come in. I think Britney Spears came in one day, and what's her name? Kardashian came in too one day. Everybody was like a buzz about it. Anyway, so I was working right across the street from Goldman Sachs. And when I remember, like it was yesterday, when these companies' stocks just started to plummet, the markets reacted. And then within months and months, the unemployment just started to skyrocket. In 2008, 2009, your unemployment was almost 10%, which is a huge number. Basically saying 1 in 10 are unemployed. Now, again, I think that data is skewed because our elected officials like to skew data. And I think that number was higher. Because I don't know how maybe someone can answer this for me. This is why I really feel strongly that the data is skewed. When you get unemployment, and you're on unemployment for, let's say, 6 months, and at that time, you could apply for extensions after 6 months and get it for another 3. So you had a 9-month unemployment. When that 9 months is over, and you now are off unemployment, that doesn't mean you've gotten a job, but they don't track you. So they're assuming that when you come off unemployment, you're now you're not unemployed anymore, so they don't count you. That's why I think that that's the number that they're using is skewed. It's faulty. It's not an accurate number, because I can guarantee you that everybody that comes off unemployment after 9 months was not employed after that. So that 10% to me probably was closer to 15, 16%, probably higher. If I remember that time, it almost definitely was probably higher. But how about that? It almost definitely was probably higher. Nicole's laughing at me like, what is this, like Captain Double Negative today? I love it. Valid. What's that? She just said it's valid. All right, so everyone, it's valid. It almost definitely is probably. It's a Danism of the day. How about that? We're going to use that as my Danism. Cool? All right. Anyway, so unemployment at that time, from a data perspective, was almost 10%. So 1 in 10 were not working. 2022, that number is 4%. And right now in 2023, it's below that. It's about 3.9, 3.8 in that area. So it was more than double in 2008 than it is now. So that is a huge number. That means that more people are working. So think about that. If more people are working and we're still experiencing a pullback in the market, it tells me that buyers are just waiting for rates to come down before they're going to go buy again. That's what that data would insinuate to me as a real estate professional. When you have that. Now, what I do know to be true is wages have not caught up with prices here. That's always been off, especially in 07, 08, but more importantly during this upswing. 18, 19, 20 in those areas, 20 from like 18 to 21, wages were not wages were stagnant. They were very flat. You didn't see people getting raises and all of that stuff, but you saw an aggressive appreciation in home prices. So you can't have one without the other. Well, you can, but now again, you're seeing people pulling back. I think a lot of that too is, and this is an opinion, but I'm noticing big companies laying off a lot of people. Amazon, Google, all these other companies laying off people, Tesla. So if they're doing it, you know that it's affecting, like if those big companies are doing it, it's happening, industry wide. So I think that's a hesitancy too, which is legitimate. If you're legitimately worried about your job, your name is not on the door of the company that you're working for, then yeah, that could be an issue. So, but from an overall perspective, a macroeconomic perspective, unemployment is eminently different now than it was then, and you're in a better position now. So all four of these factors, okay, we'll go over them again. Number one is supply. Number two is lending. Number three is equity in homes. And number four is unemployment. Those four factors are eminently different now than they were in 2008. And you're in a better position now. Am I saying that a recession is not going to happen? I mean, if I had my little ball, my crystal ball here, what do they want to call me, Nicole? Should they call me Nostradamus? Should they call me like, who's like a prognosticator? Is it Nostradamus? Yeah, he's like the most famous one. What about that David Blaine guy? No, he's not. He's not one of them. Huh? No, doesn't he like do that stuff? No. Oh, I don't. Maybe I'm thinking of somebody else. No, David Blaine. I don't know why he came up. I'm so off on like pop culture and stuff. But anyway, yeah, we'll go with like Nostradamus. He had like that crystal ball, could like tell the future. I can't tell the future. Do I think we're going to see a recession? I don't know. I wish I could say with, some kind of confidence, yes or no. I think that the real estate market will stabilize. I do, and I do say that with confidence. And by stabilization, I mean buyers will re-engage at some point. I do think that, and I think as rates start to come down and inflation starts to get, within a reasonable number that the Fed wants to see, I do think that buyers will start to re-engage. I do think that there will probably be some distressed property hitting the market. I do think that, and I think that the buyers that are out there with cash are going to scoop properties up at a discount. I do think that as well. So again, if that's something that you're looking to do, build your portfolio from a real estate perspective, I think the next 12 to 18 months will be pretty fruitful for you. Again, because of the aggressive nature of what happened in 2020 and 2021, I just think that, nobody saw that coming. And if anybody told you that they saw it coming, I think they're lying. Tell me, let me see you say that in 2019, and then I'll believe you. So the humans' reaction to what happened in 2020 is, we saw what happened in the real estate market. Prices just, sellers just asking $50, $60, $100, $120, $150,000 more for their home, and people paying it because they thought that was the best thing for them. I just never saw it. And now what we're seeing is that, again, it's that pullback. It's the same thing in that scenario seems to be similar than in 08. From when, 01, 02 to 2007, 2008. I have a friend who was in the West, and she had two homes. And she lived in one and rented the other. And, I mean, it hurts me to say. I mean, I'd only use it as an example, but, I thought that it was, when I was asked what she should do, what would she do if it were me, I said, I'd sell these things tomorrow. I said, how does anybody know when this thing's going to, and this was in 06, and it was in one of the most aggressively appreciating markets in the West, and it wasn't in California. And but one of the properties that she had was in California. But the long and short of it is she didn't, and they both foreclosed. And, she left with nothing and then rebuilt. I mean, she started over again, rebuilt. It's the great thing about where we live and being a human in this country is you can just start over again. I'm a example of that. But it just goes to show, like, these things don't last forever. And I think that when you're in it, it's very difficult to jump out of it and see, not with that tunnel vision of like, this is just going to keep going. Like, I'm just going to keep seeing, how much I can get and how high it's going to go. Man, when you're buying a property for like $300,000 and it gets appraised like 2 years later, and it's appraising for like $630,000, like, sell the freaking thing. Like, sell it, man. It's not. I mean, that's just free money. Like, it's free money. So what if it makes another 100 in 2 or 3 years? Who cares? But if what's the flip side? You lose everything that you just earned on paper. It's on paper. It's not even like, it's not even real. It's just what somebody puts on paper, and you can benefit from it. So I just share that to say, do I think this is all going to stabilize? Yes, I do. And I think that, again, buyers that have cash right now or money to spend are going to do well in the next 12 to 18 months. I really do. So that would be like my, I know it's Nostradamus, but there's somebody else, man. This is on my brain now. Who's like it's like, oh, they got the crystal ball, and they're like, ooh, like, who is that? It's not, he's like the famous one in my brain. It's like Plato and Socrates. Like, those two as theologians and like, philosophers. But there's like, there's someone that has like a crystal ball, and like, was it lady? Like, what was that lady that was on, she was on like, the old, yeah. She was on like late night TV, and she'd have like, I can tell you, like, you're like Lady Madam something. You know who I'm talking about, right? I forget I'm like way older than you. You don't probably remember. You don't probably remember when like TV was, like, when you were on TV at like 3 o'clock, TV would end. Yeah, like the American flag would come on about dun 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 dun, but it wouldn't be anything on. There wouldn't be anybody there. So I remember that. My producer does not. She says she does, but I don't think she was born yet when TV was doing that. And then it would just be like snow for like 2 or 3 hours. And then at like 6, 7 o'clock, the TV would come back on again. So yeah, imagine those days. Anyway, so that's going to be the majority of today's episode. The next episode that next week, or the week after, I should say, we're going to get into some more data. I really like getting into data and numbers because what we can do is future pace and see, we can go out 12 months, 18 months based on historical data. History always will teach us. It's just a matter of, are we going to learn? So it'll be important, and I think that we're going to keep getting into this. I love getting into data. It makes it's just more interactive, and everybody can kind of relate to it. So, and that's going to bring me into today's book, because I'm reading this book again. It's been sitting here. It is The Big Short. I know many of you know the movie. It was a phenomenal movie. I probably would say maybe if you can give me a movie with a better cast, like give me a movie, Nicole, with a better cast than The Big Short. Brad Pitt, Christian Bale, Steve Carell. I'm missing one. God, he was huge in it too. Google it for me. This was like the best cast. Anyway, Gosling. That's who I was missing. Ryan Gosling was in it. Like, that's 4 like top, I don't know, 15 actors, and like Jeremy Strong. Who's the woman? Mr. Tomei was in it. Yeah. So it's like, come on, man. This was like, if you can give me a cast of a better movie than the Big Short, like, write me on subscribe, and then write to me on YouTube or Instagram or whatever, and tell me who you think a better cast of The Big Short is. So anyway, this is the book, Michael Lewis. You know who we all know who he is. The Blind Side, Moneyball, The Big Short, Flash Boys. If you really want to learn about high speed frequency trading, which is what had a lot to do with this that's another great book to read, Flash Boys. But this is the actual book, The Big Short. Talks all about the lead up of 2007-8 and then the crash of 2007-8. And again, it really breaks it down into like terms that anybody can understand. And again, I worked for a couple lenders during that time from '04 to '07, buying what's called scratch and dent loans. So those loans they're not performing, but they could perform. So you're not going to pay. They're not A paper, quote unquote. They're like BC paper. So you're going to get it. You're not going to get. You don't pay the whole thing. You get it at a discount. And then if there's something that will make the loan perform later, now you have A paper. You've bought it here and can sell it here. So it's what I used to be involved in. So I have a background in this. So anyway, great book. The Big Short, Michael Lewis, he's just such a power player, man. Liar's Poker, another great book. He's just really talented, and he writes it in a way where anybody can understand it. And this was a really powerful time in our lives. Anybody who was alive during that time, 2007-8, mass calamity. Many people thought the United States economic system was going to collapse. The dollar was going to be worth nothing. Companies like Bank of America, Citibank, Chase were literally worth, like, I don't even remember this call. They were worth like, Bank of America stock, I think at its lowest was like $1. It was like $1.50. I don't even know what it's trading at now. Like, pull up Bank of America. What's that stock trading at right now? It was like $1.50 back in '08 or '09 when it was at its low. $35. Imagine buying that stock in 2009 or 8 at like $1.50. It's insane. These companies were all worth nothing. Chase, Citibank, because they were all involved in this. They're buying these loans too. So, and then you had companies like Bear Stearns, gone, 100-year company. Merrill Lynch, gone, 100-year company plus. Lehman Brothers, 100-year company plus, gone. All of these companies were just going away like daily. And I remember, like, it was just like people literally thought that this was like the end of the world. So this was a major, major calamity and a major event in our human history, which made lending literally go from one side all the way to the other. That's one thing about the United States that it is what it is. It annoys. It's very annoying. We don't just do like a 55. If something happens, we don't just go 0 to 55. We're going to go 180 the other way. And it's just not the way things are supposed to go. Take a step back, take a breath, learn from what happened, and then you make your decisions. You don't just do these huge changes because, again, there was a reason and a need for a subprime lender. There still is. People just took advantage of it. That's all. Anyway, Big Short, great book. Read it. Takes us into the last part of the show, the Danism of the day. Although what did I say the Danism was? Oh, it most definitely will probably do that. That's like the greatest Danism. Come on, you're going to use that with your friends. I know you are. You're going to be like, guys, I most definitely think that we probably would do this. I love it. All right, guys. Danism of the day, change is inevitable, but growth is optional. Think about that, man. That hit me like a ton of bricks the one day. Change happens literally like every day, every moment change is happening. But are we going to grow from that change, or can we take it one way, or we're going to take it another way? So that's how I look at it. Life, circumstances, people, scenarios, they all change daily, momentarily. Are you growing with that constant change? That's the question I'll ask. I'm not going to sit here and go on a whole soliloquy about, what I did and all that stuff. I did not always operate in that manner. I did not. People close to me and my previous self will tell you that I would change. With that change, I was not growing because I didn't think it was needed. So change is inevitable. Growth is optional. And with that, signing off. See y'all next time. We're going to talk again. We're going to get into some more data about where we are in the markets and what we can see in the future moving forward. So that'll be on the next episode. For my producer, Nicole, who is laughing at my Danisms. And for all y'all out there, be strong, be well, and love your life, y'all. Till next time.